Preparing for a regulatory reporting, Basel III, COREP/FINREP, CCAR, FR, Y-9C interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is regulatory reporting, and why is it critical for banks? The interviewer wants to assess your understanding of the purpose of bank regulatory reporting, how it supports supervision, and whether you appreciate accuracy, controls, data lineage, and cross-functional ownership. While answering, focus on reporting as a governance process, not just form completion. Mention supervisors, capital and liquidity monitoring, source data, reconciliations, sign-offs, audit trail, and consequences of errors. Regulatory reporting is how a bank translates its financial, risk, and capital position into prescribed filings for supervisors. I think of it as the control bridge between finance, risk, treasury, and regulatory rules. The numbers drive capital adequacy monitoring, liquidity oversight, stress testing, and market confidence. A small mapping or classification error can change ratios, trigger remediation, or create credibility issues with regulators. So accuracy, governance, and audit trail matter as much as the calculation. Question 2. Walk me through the Basel III capital stack and how it appears in regulatory reporting. The interviewer is testing your understanding of Basel III capital quality, loss absorption hierarchy, and how CET1, AT1, Tier 2, buffers, RWA, and leverage ratios interact in prudential reporting. Make sure to cover the capital stack, deductions, going concern versus gone concern capital, minimum ratios, conservation buffers, and why high-quality capital is measured against both risk-weighted and leverage exposure. Basel III starts with Common Equity Tier 1, the highest quality capital, common shares, retained earnings, and qualifying reserves after regulatory deductions. Additional Tier 1 absorbs losses on a going concern basis, typically through perpetual instruments. Tier 2 provides gone concern loss absorption, such as subordinated debt. In an interview, I would link the stack to minimum ratios, buffers, RWA, and leverage exposure, because capital quality only matters when compared with the risk base it supports. Question 3. How would you calculate credit risk RWA under the standardized approach? This question evaluates whether you can translate regulatory credit risk concepts into actual reporting mechanics, including exposure classification, risk weights, credit conversion factors, collateral, guarantees, and standardized versus model-based approaches. In your answer, talk about EAD, product and counterparty categories, off-balance sheet conversion, eligible mitigation, jurisdictional rules, and the importance of validating data attributes before calculating and filing RWA. For credit risk RWA, I start with exposure at default, then apply the relevant risk weight under standardized or internal ratings approaches. A sovereign, bank, corporate, mortgage, or defaulted exposure can attract different treatment. Credit risk mitigation, collateral, guarantees, netting, and conversion factors can change the number. The key is not just multiplying exposure by a weight, it is confirming product classification, counterparty type, jurisdictional rules, and data lineage before reporting. Question 4. What is the difference between COREP and FINREP? The interviewer wants to assess whether you understand the division between prudential and financial regulatory reporting, and can explain how accounting data feeds regulatory templates without confusing COREP and FINREP objectives. Be sure to mention COREP capital, liquidity, leverage, and large exposures, FINREP financial statements and IFRS detail, plus reconciliation, shared source data, template instructions, and transformation rules. COREP is mainly prudential, own funds, capital ratios, leverage, large exposures, liquidity, and risk-weighted assets under the EBA framework. FINREP is financial reporting, balance sheet, income statement, impairments, fair value, and detailed accounting breakdowns, usually aligned to IFRS. The connection is that FINREP feeds many source balances, while COREP transforms them through regulatory filters, deductions, and risk rules. Strong candidates explain both the overlap and reconciliation discipline. Question 5. How does CCAR fit into a bank's capital planning and regulatory reporting process? The interviewer is testing your understanding of U.S. stress testing, capital planning, and the reporting controls needed to support CCAR projections, model outputs, assumptions, governance, and supervisory review. While answering, focus on scenarios, projected losses, PPNR, capital actions, ratios under stress, model documentation, management challenge, reconciled actuals, and evidence supporting each submitted number. CCAR tests whether a large bank can maintain capital above required levels under baseline and severely adverse scenarios while executing its capital plan. I would describe the process as scenario translation, balance sheet projection, PPNR, credit losses, market losses, operational risk, taxes, and capital actions. The reporting challenge is evidence. Assumptions must tie to models, controls, governance approvals, and reconciled actuals. Supervisors focus heavily on repeatability and management challenge. Question 6. What is the Y-9C and what information does it capture? This question evaluates your familiarity with Federal Reserve Holding Company reporting, especially the purpose of Y-9C schedules, consolidation scope, GAAP basis, capital data, and supervisory analytics. Make sure to cover who files it, the types of schedules included, links to call reports, regulatory capital reporting, consolidation considerations, variance analysis, and importance of following Fed instructions. Y-9C is the consolidated financial statement filing for U.S. bank holding companies and certain savings and loan holding companies. It resembles a regulatory version of financial statements, with schedules for balance sheet, income, regulatory capital, off-balance sheet items, loans, deposits, and risk-based capital. I would emphasize consistency with call reports where applicable, GAAP-based starting points, regulatory instructions, and strong variance analysis, because the Fed uses it for supervision and peer analytics. Question 7. What controls would you expect over a regulatory reporting production process? The interviewer wants to assess your practical control mindset, including how you prevent, detect, investigate, and evidence errors across source systems, transformation logic, regulatory templates, and final submissions. In your answer, talk about upstream validations, mapping controls, reconciliations to GL, automated edit checks, variance reviews, maker-checker sign-off, lineage documentation, issue logs, and remediation tracking. I would build controls across the full reporting chain, not only at submission. Upstream controls validate product, counterparty, collateral, maturity, and accounting attributes. Transformation controls test rule logic, mappings, risk weights, and eliminations. Output controls include reconciliations to GL, prior period variance analysis, edit checks, and sign-off. Finally, I would keep lineage documentation and evidence so an auditor can trace a reported cell back to source transactions. Question 8. If the CET1 ratio drops unexpectedly quarter over quarter, how would you investigate it? This question evaluates analytical troubleshooting skills and whether you can isolate capital ratio movements by numerator, denominator, business activity, data changes, deductions, RWA drivers, and reporting defects. Be sure to mention building a CET1 bridge, checking retained earnings, OCI, dividends, regulatory deductions, RWA by risk type, reconciliation to source systems, and escalation of unexplained breaks. If CET1 falls unexpectedly, I would first split the movement between numerator and denominator. On the numerator side, I check profit, OCI, dividends, deductions, deferred tax assets, intangibles, and prudential filters. On the denominator side, I review RWA changes by credit, market, and operational risk, including book growth and model changes. Then I reconcile to GL, risk systems, and known business events before escalating a concise bridge. Question 9. Explain the leverage ratio versus risk-based capital ratios. The interviewer is testing whether you understand why regulators use both risk-sensitive and non-risk-sensitive constraints, and how leverage exposure can bind even when RWA-based capital ratios look strong. While answering, focus on capital divided by RWA versus Tier 1 capital divided by leverage exposure, model risk, backstop purpose, off-balance sheet exposure, and practical balance sheet constraints. Risk-based capital ratios compare capital with RWA, so exposures with higher credit or market risk consume more capital. The leverage ratio is simpler. Tier 1 capital divided by a broad exposure measure without risk weighting. Its purpose is to stop banks from appearing well capitalized only because modeled risk weights are low. In practice, both matter. A low-risk balance sheet can still be leverage constrained if total exposures are large. Question 10. You discover a product mapping error after submission. What do you do? This question evaluates your judgment under pressure, including error triage, materiality assessment, stakeholder escalation, resubmission considerations, root cause analysis, documentation, and control remediation in a regulated environment. Make sure to cover impact quantification, affected reports and periods, legal entity scope, materiality thresholds, governance approval, regulator notification where required, audit trail, and preventive mapping controls. I would handle it like a control event. First, quantify the impact by report, schedule, period, legal entity, and ratio. Second, identify root cause, source data, mapping table, transformation rule, or manual adjustment. Third, assess materiality against internal and regulatory thresholds. Then involve reporting governance, controllers, risk, and compliance. If resubmission is needed, I would document the error, correction, approvals, regulator communication, and preventive control enhancement. Question 11. How does IFRS 9 expected credit loss reporting affect FINREP? The interviewer wants to assess whether you can link accounting standards to regulatory templates, especially IFRS 9 staging, expected credit losses, impairment movements, FINREP disclosures, and loan portfolio analytics. In your answer, talk about Stage 1, Stage 2, Stage 3, 12-month versus lifetime ECL, credit-impaired assets, allowance reconciliations, income impact, template population, and controls. In FINREP, IFRS 9 matters because credit impairment is reported through staged expected credit losses, not only incurred losses. Stage 1 uses 12-month ECL. Stage 2 and Stage 3 use lifetime ECL, with Stage 3 reflecting credit-impaired assets. I would connect this to loan classifications, allowance movements, income recognition, and disclosures. The reporting team must align finance ECL outputs with regulatory templates and explain movements clearly. Question 12. What is large exposure reporting, and what makes it difficult operationally? This question evaluates your understanding of concentration risk reporting, connected client groups, aggregation challenges, regulatory limits, eligible mitigation, and why counterparty hierarchy data is critical. Be sure to mention client grouping, legal entity aggregation, guarantees, collateral, derivatives, securities financing transactions, Tier 1 capital limits, breach escalation, and data quality over counterparty relationships. Large exposure reporting is about concentration risk. The bank must identify exposures to a client or connected group, apply eligible credit risk mitigation, and compare the result with regulatory limits, often linked to Tier 1 capital. The hard part is aggregation. Legal entities, guarantees, funds, derivatives, securities financing, and wrong-way risk can create hidden concentration. I would stress accurate counterparty hierarchy data and timely escalation of breaches or near breaches. Question 13. How would you explain LCR and NSFR in a regulatory reporting interview? The interviewer is testing your ability to explain liquidity regulatory reporting, especially the distinction between short-term stress survival and structural funding stability under LCR and NSFR. While answering, focus on HQLA, cash outflows, cash inflows, stable funding, required funding, maturity assumptions, collateral eligibility, encumbrance, deposit classifications, and reconciliations to Treasury data. The LCR asks whether the bank has enough high-quality liquid assets to survive a 30-day stress outflow. NSFR tests whether longer-term assets are funded with sufficiently stable liabilities over a one-year horizon. In reporting, classification is everything. Deposit type, counterparty, encumbrance, maturity, collateral eligibility, and behavioral assumptions drive outputs. I would always reconcile liquidity templates to Treasury sources and explain major movements versus business activity. Question 14. A COREP template does not reconcile to the general ledger. How would you approach the break? The interviewer wants to assess reconciliation discipline and whether you understand that regulatory templates may legitimately differ from accounting balances because of scope, prudential adjustments, and transformation rules. Make sure to cover a layered reconciliation from GL to source to engine to template, expected adjustments, timing differences, mapping defects, evidence retention, ownership, and correction workflow. I would not assume the COREP template is wrong just because it differs from GL. Regulatory reporting often starts with accounting balances, then applies scope, consolidation, prudential filters, netting, deductions, and risk transformations. My approach is to reconcile in layers: GL to reporting source, source to regulatory engine, engine to template. Differences should be categorized as expected adjustments, timing items, mapping issues, or true breaks requiring correction. Question 15. How would you prepare for a major regulatory change, such as Basel III final reforms or Basel III endgame? This question evaluates regulatory change execution skills, including rule interpretation, impact assessment, business requirements, systems implementation, parallel runs, control updates, stakeholder governance, and go-live readiness. In your answer, talk about identifying affected products, entities, templates, data fields, calculation logic, policy decisions, testing strategy, old-new comparison, documentation, approvals, and post-implementation monitoring. For a regulatory change, I start with an impact assessment. Which templates, products, entities, ratios, data fields, and systems are affected? Then, I translate the rule into business requirements, update mappings, build controls, perform parallel runs, and compare old versus new outputs. I would involve policy, finance, risk, technology, and legal early. The strongest implementation is not just compliant on day one. It is explainable, controlled, and scalable. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.